Hey, Rob B here with Rob D. By the end of this episode, you are going to be in such a better position of understanding how money works and how inflation that's rampant right now is a given. But it's one thing accepting it, but there's another thing understanding it. And if you understand it, you can fight it. This week's episode is so important. I put it in one of the top 10 must-listen episodes we've ever done. So make sure you take notes.
Welcome to the Property Podcast. Rob D here with Rob B. We spend our weeks advising a multi-million pound property fund, which you can find out more about at portfolio.co.uk. And over the years, we've put together hundreds of property transactions. This is a show where we bring you all the knowledge we've gained along the way for free. Today, like Rob said, we are focusing on a topic. It's hard to imagine anything more important than this. It governs the entire landscape that you're making your investments in, and it gives you a framework for understanding what that landscape is going to look like in the future. For the last 50 years, whether you know it or not, you've been living inside a giant financial experiment. And we're going to be talking about the implications of that in this episode. And make sure you stick around to the end, because in Hub Extra, I'm going to be sharing something that I've spent hundreds of hours working on for years now. And I think there's a lot that you can gain from it.
So it's time for our news story of the week. And we expected this week's news story to be a biggie because the government was leaking stories that they were going to transform the UK property market, and their announcements were going to make such a difference to so many people. And maybe that's the case. I don't know about you, Rob, but I felt a little underwhelmed by the announcements from Boris Gove and co. It didn't seem to actually have the impact that we were all expecting.
No, I was all geared up to do a special emergency episode of the Property Podcast. I was ready. But then I was sort of looked at the announcement. I was like, have I missed something? Is that it? So announcement, I'll sort of say what I understand of this, and you can tell me if I've missed anything, is that Right to Buy, which obviously was the scheme that people can buy their council home at a discount, is being extended to housing association homes, which it sort of was already, but now it's extended it further. But most of them, you're actually not going to be able to. So they've sort of taken a policy that exists and extended it a bit, but not really. Is that it? Am I being unfair?
I don't know if you're being unfair, but yeah, you've got the gist of it. Not that I'm some expert on this, because it's hard to be an expert because there's no information. But from reading a handful of articles, it seems like they're replicating what they do with council houses right now, where you can buy a property at 70% of the value. But there are no schemes ready to go. When the schemes start, there'll be pilot schemes at first, because no new government money will be put into the initiative. Apparently, eventually, the government says 2.5 million people will be eligible to take advantage of it. But that is a long way off yet. So the Right to Buy scheme, I think, was a lot of headline. Typical, as we've learned over the years, not a lot of detail. And we'll see if it actually happens, because, again, not all policies that are announced are actually delivered. So I know we sound sceptical, but Rob, I think we've done this long enough and have seen enough announcements over the years by governments to go, okay, it's okay to be sceptical, because we've seen so many things not happen or be watered down. What has caught our attention, though, is that there's going to be a review of the mortgage market for first-time buyers. And Michael Gove has said that they're going to do a review to make it easier for first-time buyers to access the market. Again, not a lot of detail, Rob, but that actually hidden in all the information could be the bigger story here.
I think so, because that is what's going to have a real impact on the wider housing market, because it kind of fits into this theme that we've talked about a little bit about loosening lending. So we've said before that you have some kind of crash, everyone will put some very sensible measures in place to stop it from happening again, and then those get forgotten gradually over time as they become inconvenient. And this seems like it falls into that bucket. They're looking at ways of allowing people to use smaller deposits or to borrow more or whatever. So if any of that ends up happening, and this is a big if, I've had my bags packed ready to move to one of George Osborne's garden cities for years now. It still hasn't happened. But if this happens, then that could actually make a far more meaningful difference to the market than the housing association thing. But we will see.
Now, before we get going with this very important episode, there's a very important announcement. And Rob, it's a bit of a celebration day. No, it's not your birthday or mine. It's the release of your new book. And it's been a long time since you've put a book out to the world. And I'm really, really excited about this one. Of course, I love property and I love the books that you've done on property. But I'm not just saying this because it's the most recent. I promise you, this is the one that I'm most excited by far. Because I think this is the one that will have the most impact on the most people. It's a book that if people read and understand it, it will change their whole world on how they view money.
Well, I will not disagree with that. Thank you. Yes, I think so too. The book is called The Price of Money. It's out today. I can't believe it's actually out. I can't believe I finished it. But the idea is it gives you a framework for understanding how the financial system really works. And almost everything that you intuitively think you know and everything that you've been told historically, most of what you see in the press is wrong. And that will lead you to make the wrong decisions about what to do with your money. So in this book, I do actually spend a couple of chapters talking about, given how things are likely to be in the future, what should you do with your money? What kind of investments will work and what kind won't? And that's great. But I think the real valuable bit is actually before that is like giving you the ability to understand all this stuff for yourself, because that then puts the power in your hands. You have the ability to look at the news and see what's happening and cut through all the nonsense and really understand what's going on. So you don't have to keep coming back and hoping the book's been updated. From then on, forever, you can make better financial decisions. That's what it's all about. I've worked really hard on it to make it really simple and easy to understand and kind of fun. I've worked really hard on it to make it short, which I know is a weird thing to say, but writing a short book is actually much harder than writing a long book because you have to think carefully about what goes in and what comes out. It's certainly not an intimidating read. You can get through it within a week. And like I said, it's out today. So if you go to Amazon and search for my name, you'll find it there. Or you can go to propertyhub.net/money and that will redirect you straight over.
Well, I know, Rob, you'll be on Amazon later watching it fly up the charts. I will be as well. It's going to be such a popular book. And if you want to get your copy, pause the podcast. Get it now. Go to Amazon or go to propertyhub.net/money and pick up your copy. It's out today. Very exciting.
Do you remember 1971? No, nor do I. I wasn't alive. And nor were you, Rob. But you listening, maybe you were around in 1971. But chances are, even if you were, you will not have thought about this major event that happened in that year that has actually transformed everything about the world of money that we live in today. In this episode, we're going to talk about what that was. We're going to talk about what's played out ever since. And then the important bit, we're going to talk about what that means for what's going to come next. Because there's so much noise, there's so many opinions about people talking about what central banks are going to do, what's going to happen with interest rates, what's going to happen with inflation. And most of it really is just noise. If you zoom out and look at this super big picture, look at how we've got to where we are, that tells you what's going to happen next. And once you understand that, you know how best to position yourself to make smart investments. So not a small topic to cover today, Rob, only doing 50 years or so of financial history. So we better get started. Rob, what did happen in 1971?
Well, Rob, in 1971, Disney World opened,
Ooh.
Which is a very important thing to me. The 26th Amendment was apparently introduced, and the UAE was established. So a lot happened in 1971. And as much as I'd love to talk about Disney World, that is not what we're going to be talking about today. Because what we're going to talk about, arguably, has impacted the world than any of those huge events. And still today, all these years later, it impacts us. Okay, so I'll reveal it. In 1971, we came off the gold standard. Before we get into the impact of that, and the impact is absolutely huge, let's just do a quick reminder of what the gold standard is. So the gold standard was ended in 1971 by President Nixon. Before 1971, the dollar was pegged to an amount of gold. If you wanted to redeem dollars for gold, you could. Now, this was watered down up until 1971, and this had been in place since 1945. And the reason why we're talking about America, and it's so important that America came off the gold standard, is that because America was and still is the world's reserve currency. And that, again, had been since 1945. So up until 1971, the dollar was pegged to a physical amount of gold, and you could trade the two. Since 1971, though, that was abolished. So what does that mean? From that point onwards, the US government and other governments around the world, who also abolished the gold standard at roughly the same time, were able to create as much money as they wanted. It used to have to be backed by gold, and now it's backed by thin air, sometimes called a fiat currency, which basically just means that it's backed by nothing. And the reason why we value it is not because it's backed by something, but because we trust it. And because we trust in these currencies, we are comfortable as a society, currently at least anyway, to accept that it's not backed by anything and just accept that it's worth something.
That's right. And you said, Rob, that the gold standard was abolished in 1971, goes back to the 40s, and that is absolutely true. But the point is, before that, whatever the dominant global currency has been throughout time, it's now the dollar, it was previously the British pound, way back it was the Dutch guilder. It's always been backed by something. Always throughout history, except at times of war when it temporarily gets abandoned. But under normal circumstances, always backed by something. This is the first time ever in history that the world's reserve currency, the US dollar, as well as the pound, the euro, the yen, everything is backed by absolutely nothing. That's why this is a big deal. We're now seeing the impact of what happens when you've been on this system for 50 years, because we've never seen it before. It's never happened. I think it's also worth noting that this is supposed to be temporary. The thing that Nixon announced in 71, this was supposed to be a temporary move. And this is proving to be temporary in the same way that income tax was supposed to be temporary when it came in hundreds of years ago. When it's convenient for governments to do something and they kind of get away with it, that tends to stick around. So that's what happened. Effectively, the brakes came off. Prior to 1971, there was some kind of constraint on the amount of money that could be created because it's supposed to be represented by some amount of gold. Since then, that constraint is no longer in place. That means that, in theory, any amount of money can be created. I think, Rob, it's fair to say that if you look at what's happened since 1971, quite a lot of money has been created.
Oh, yes, they've certainly created a lot of money. Like, if the restrictions aren't there, and it can help you in the short term to have more money on hand, then why wouldn't you? You know, the thing is with politicians across the world, not our own, and this is across all parties, so I'm not picking on any in particular here, but they're in it for the short term. Unless you are part of a dictatorship, you're not going to be in power for a long time. So if you can make things look better by increasing money supply and spending in the short term, you would. You're incentivized to do that because you want to stay popular for as long as possible. So you spend money to stay popular. And without exception, every government has done that in the US, in the UK, and many places across the world. So you can go to Rob's book and see this chart. This chart looks huge. It's completely flat and it just rises into the sky. So money supply has gone through the roof, but also so has debt. And our proportion of GDP has increased since the 70s from 60% to 200%. And that's because the money supply is created from the Bank of England and the Federal Reserve and the other central banks across the world, but also by banks themselves. And that's what causes debt, because money is created by these banks, but then it needs to be paid back. And debt has gone through the roof as well. It's astonishing by how much it's grown. Again, you've got this wave that's fairly settled, and then you've got this massive amount of growth. Now, has any government tried to tackle this? Because debt, that doesn't sound good, right? We all think, well, let's reduce the debt. As a concept, we can all get our heads around that. Let's get this debt down. What are we doing? Well, recently a government tried that, and that was the Tory government, which had the austerity measures. And that was basically a nice fancy way of saying, let's get the debt down. And they tried to address that issue. And they did. They did start to bring the percentage down. But they created austerity. And that's not popular. And understandably so. It meant that people's lives, a lot of people's lives at least, are misery. You know, people were having to go to food banks. The UK was not a nice place. It was starting to become the haves and have-nots. And that's not right. So you could say the way they addressed austerity was wrong, but ultimately it wasn't a vote winner, and understandably so, because so many people suffered. So, what did they do? Well, they started spending again. Of course they did. And they started increasing the debt again. And a lot of people hate different parties, and this is not an endorsement or a critique of any particular party, and we know get some people with their knickers in a twist whenever we talk about politics. But the Tory government became a bit more popular again when they started spending again. So governments are incentivized to spend because they're in it for the short term. If they're in power, they want to stay in power. So how can they stay in power? By pleasing everyone. And how can they please everyone? By spending money. But by spending money, they increase the debt. So we're in this vicious cycle that our country is run by people who want to stay in power. And to stay in power, they have to please us. And to please us, they have to spend, which means that public debt as a percentage of GDP has been going up and up and up.
That's right. And again, the early 70s was the point at which this pattern in terms of government spending really became entrenched. Prior to that, governments behaved pretty much like you'd expect they would. They'd have years where they would bring in more from taxes than they spent, and they'd have a surplus and they'd save that up. And then they'd have years where the economy needed some more support, they wanted to spend some money, and so they then spend that surplus and then maybe run a deficit, and then they'd recover that deficit in a previous year. That completely shifted. Since 1971, there have only been 6 years in the UK in which the government hasn't run a deficit. And when we're talking about what the Conservative government were doing, all they were trying to do was get rid of the deficit. They weren't even getting to the point of paying the debt down. They were just trying to have some years in which they weren't spending more than they brought in. So really, it was an exercise in not piling up more debt rather than just reducing the debt that we had. And the fact that it was so painful and didn't work shows you that this is structural. Things have reached a point now, 50 years into this, that debt is never going to get paid down. And it's the same in terms of private debt as well, because everyone gets very concerned about government debt, but private debt is absolutely massive. As a proportion of GDP, it's increased from 60% in the 70s to 200% today. That means that it's not just the country that's in debt, it's everyone in the country is in a load of debt. And that is very important in terms of the future of interest rates, which we'll come to a little bit later on. So that's the general pattern that we've seen since 1971. But within that, there have been two kind of major inflection points where the amount of money in the economy has just gone absolutely crazy. And each of these in my book, I dedicate a separate chapter to each of them because they're such consequential events. The first one of those is 2008. We don't need to talk about 2008 too much because you'll know what happened. We've talked about it on the podcast a lot, and it's kind of still in the public consciousness. We know that interest rates were cut. They were cut from 5.75% all the way down to 0.5%. They went lower than that before coming back as well. And we saw the advent of QE, which is basically a fancy word for money printing, and £200 billion was printed in a single year. The result of that was interesting and not necessarily what you'd expect. Based on what we talked about last week, you'd expect introducing a whole load of money into the economy to be inflationary. But in terms of consumer prices, it wasn't, because, without getting into too much detail, that money ended up getting stuck in the financial system. I do get into the mechanics of QE in the book because it is really interesting, but I'll spare you for now. The other thing that I think is really interesting about this, and is poorly understood in general, is that as a result of interest rate cuts, and especially of QE in 2008, asset owners were enriched. And asset owners were enriched on purpose. If you actually go back and look at the Bank of England paper from 2009, where they were talking about this, the whole point of QE was to generate something called a wealth effect. And that basically means you take people who own assets, who are already rich, you make them feel rich, and as a result of them feeling rich, they go out and spend more. And as they spend more, supply and demand, that creates inflationary pressure, which staves off the risk of deflation, which is what everyone was worried about at the time. As a mechanism, I just find that so interesting. Because I say it's poorly understood, it hasn't been spoken about much. And I think the reason for that is it sounds really bad. The entire point of the policy was to take people who were already wealthy and make them wealthier. You can debate the extent to which it did sort out the economy, and I've got some data about it in the book. But I imagine if people were aware of exactly what the idea behind this policy was, whether it worked or not, there'd be quite a lot of unhappy people out there.
So understandably, in 2008, we took action, and whether it was the right action can be debated, and that's up to you to decide once you've read Rob's book and got more information. So we were on the brink of financial abyss in 2008. But then in 2020, we had a global pandemic. And again, the Bank of England, probably leaned on heavily by the government, took massive action. And they decided to do another round of QE. But it wasn't a few quid. It was 450 billion. Let's put that into context. 2008 was massive, right? It's more than the entire time since 2008 in a single year. in 1 year. So that is just staggering. We've done so much QE over the years, and then in 2020, we blew it all out the water, and then did more since '08 combined. When you've stopped to even think about that for a second, is just bonkers. But it happened. So again, like last time, asset prices benefited across the board as well. So yes, property's gone up massively, and that's been one of the main drivers between property prices rising recently. Stocks, bonds, gold, they've all gone up. And since '08, and then supercharged more recently. And that's because QE has been supercharged. But this time, it didn't get stuck in the financial system, or not all of it anyway. So they, for the first time, redirected how QE was spent. And the government spent it directly. So we had things like furlough, which you may remember, which I'm not saying these were the wrong things to do, but the government was spending a lot of money, and they didn't have, a load of cash saved up over the years to dip into. So they created money to spend. And that's why we've had a lot more general inflation as well. So we've had a lot of asset inflation because of what happened in '08 and 2020. But more recently, we've had more general inflation, which you've been feeling on a day-to-day level, which is, your bills are going up, your energy bills, the food shop's going up. And this is because of that money that was spent then. Because what happened is the government gave everybody more money to spend. So there was more money supply, and there was more money going around, and that money was being spent on goods and services. And there was a spending boom, and that's what the government wanted, but it went too far. And now the consequence of that is inflation. Now, the government is never going to hold their hands up and go, hey guys, this inflation we've got, it's all on that. They could conveniently blame Russia and the pandemic and the supply chain issues that they have getting stuff over from China since COVID. That has had an impact. But let's not pretend that that's the main driver. It's not. It's a driver, absolutely. The main driver, without question, undisputable, is the QE spend has driven inflation. The government won't hold their hands up to it, and you could argue that it was the right thing to do. That's for you to decide. But they did it, and this is the world we live in now because of it.
That's right. That is where we are. But where does this leave us as individuals, as investors, as people trying to make the best decisions about our own money as we can in this world? What do we do? Whether you agree with what's happened or not, you can't change it. But you do need to understand it, because when you understand how we've ended up at this point and some of the decisions that have been made, you can then get clues about what's going to happen from now onwards. So let's have a recap of where we are. We are 50 years into a financial experiment, and it is an experiment. Like I said, this has never happened in history before. We don't know how this ends. We're going to find out at some point. We know that the amount of government debt has grown to a point where it can never be reduced and will just keep growing. We've covered that. And we also know that private debt, the debt of individuals and companies, is 3 times higher than it was in the 1970s. What does that mean? Well, this for me is the critical piece. It means that interest rates, which are currently very, very low, not as low as they were a year ago, but still low, are stuck at these low levels. Because if they normalise, if they get back to the 5-ish% that they were before 2008, nobody is going to be able to afford the interest payments. The government would be bankrupted, and so would everyone else. The amount of debt in the system is now so high that the only way for the payments on that debt to be affordable are for interest rates to be really, really low. If interest rates came up, it would crash the stock market, the property market, the bond market, waves of defaults everywhere. The government would be forced to print a whole load of money to avoid defaulting. It would be an absolute catastrophe. And that, for me, explains why central banks are doing so little about fighting inflation at the moment. We're in a situation in the UK where inflation is at, like 8-9%, possibly more. And the Bank of England is like messing around, raising interest rates by 0.25% and debating whether they should keep doing that or not, or whatever, which seems insane if you are working from the principle that, well, they should be fighting inflation, therefore they should increase interest rates. The point is they can't increase interest rates anywhere near as much as they need to. So basically all they can do is talk tough. They hope that by talking about all the things that they're going to do, inflation's going to come down on its own, because in reality, their hands are tied.
You're absolutely right, Rob. And the central bank, not many people feel sorry for the central bank, but I actually do feel slightly sorry for them, because you've got politicians now calling them out going, hey, it's your job to keep inflation down. What are you doing about it? deflected from ultimately what was government policy, spending all that money, putting it into the system, which has caused the inflation. I'm now pointing at the Bank of England going, hey, it's your fault. Very convenient to do that. It's not us, it's the Bank of England. They don't know what they're doing. And not only are they deflecting the blame, but you also have to remember that inflation devalues debt. So we talked about this on last week's podcast. And if you have not listened to that, you really, really must go back and listen to it because it'll help you understand this even more. So the government has a tremendous amount of debt. And we've talked many years ago on the podcast about how the only realistic way for them to erode this debt is not to pay it down. It's to use inflation. I'd love to know how many years ago we were talking about this, but it was years ago, and we've talked about it more than once because it was obvious there was no way they could address this debt problem. Austerity was miserable and it made the slightest dent. It hardly had an impact. So that didn't work. The only way out for the government is to let inflation run because that will devalue the debt. Now, I'm not saying that they're doing it on purpose, but you can say they are incentivized to do it because that will help one of their biggest problems that they have. And because of the actions that have been taken, we're going into an inflationary period now, and that will carry on for the next few years. So it's not a 1 year thing. This is not going to all go away next year. This is going to happen now for a number of years. And it might not be as high as it is now. It might be higher, but it'll still be higher than the long-term average that we've been used to. It's just going to be higher now. The average is going to be higher. So it's so important that you understand the impact inflation has on you. And that's why you must listen to last week's episode if you haven't already. And last week's episode will also give you an insight on how not only to avoid being punished by inflation, but also prosper. And next week, we're going to take that a level further. And we're going to tell you exactly what you should be doing investment-wise so you can come out of this better off. I know it's crazy, right? It looks like everything's stacked against you. And in some respects, it is. But there are maneuvers, there are things you can do that not only will help you survive, but thrive. And that is so important that this message gets out because so many people are going to be punished by this. And that's awful. It's rubbish. It's not a nice thing. But there are things you can do to actually prosper. Crazy as it sounds, you can. So we're going to go into more detail on that next week. So set your alarm clocks. Make sure you listen to that episode because along with last week's episode, next week's is a must listen. Now it's time for Hub Extra, the part of the show where we like to give you more. And of course, this is backed up by our email that comes out each and every Friday. You can get that by going to propertyhub.net. But today, it will be no surprise to you that our Hub Extra resource is Rob's new book, The Price of Money. It is out today, and maybe you've already purchased it because we mentioned it earlier in this show. And if you have, congratulations to you. You clearly are a switched-on individual. But if you've enjoyed today's episode at all, like if this has been interesting to you, the fact that you've got this far into the pod means that you probably should get your hands on a copy of Rob's book, The Price of Money. It's a small investment. It's not so Rob can retire. It's just him sharing his knowledge, which is vast, on this subject. This podcast is scratching the surface of what you should know and understand. So the book really will help you absorb those lessons further and then really have a completely different view on the world when it comes to money. Big claim, but this book will deliver it. So make sure you head over to Amazon now or go to propertyhub.net/money. And grab your copy.
Well, that's us done for another week, but do make sure you come back and join us next Thursday because we've got a bit of a follow-on episode from this one that's going to help you put some of these ideas into action. So you definitely won't want to miss it. In the meantime, you can find us on all the socials at Property Hub UK if you've got anything to share, and you can find out more about Portfolio at portfolio.co.uk. Anyway, I need to go now because I need to go refresh the Amazon charts for the first and not the last time today. So we'll see you soon. Bye-bye.
Bye-bye.